Once again, welcome to the Harmonic Trader Monthly Program. My name is Jonas Hunter, and I'm here with Scott Carney, creator of the Harmonic Trading Approach. We'll examine a variety of markets from the perspective of harmonic trading and review Scott's topics that he's addressed in his monthly report. You can access a free trial to Scott's monthly report at his website, harmonictrader.com. That's harmonictrader.com. All right, let's get started and see what's in Scott's brain this month. Well, Scott, the news is right now out of China that they had pretty much predicted a 7% growth in their economy, but they're reporting a 6.9% growth. Can you believe them, and how does that affect the overall economic picture?
Never, Jonas. You can't believe those numbers. How you doing? Great to be back with you. But no, that's why we do. That's why we measure the market. That's why we specifically look at the trading action to make our decisions. And really, all of the factual information that all traders and investors need can be found in the analysis of market action. Now, when we're looking at China, what we're really talking about is an economy that is still recovering from the 2008 crash. And that's pretty remarkable, especially when you look back on its history. You're looking at an economy that in the first 10 years of this century, basically from the early 2000s up until about 2007, that's an economy that grew immensely. And, since 2008, despite a lot of stimulus, they have failed to recover. In fact, the Chinese market wasn't even able to really overcome a 50% correction from the 2008 low. And since this latest decline that we've seen since August, based on their currency devaluation, China finds itself back at the same point that it was in 2011. So this is a market that's moved sideways, not particularly strong in any regard. And we have some clear technical harmonic trading scenarios that define those key points. Now, if I'm looking at the Chinese market, a great trading vehicle, a great vehicle for that market is the FXI. That's the iShares China, the big cap China index. Now that ETF, that's really kind of experienced quite a range so far this year. That ETF opened the year around 40. And then in the first quarter of the year, the Chinese government announced that stimulus plan, and that saw that ETF surge all the way up to about 55. And that took it out to a new high. They also came out and said, okay, growth isn't going to be quite as strong. And that's right when we saw the big rollover. And so it was kind of an over-exaggerated move where you saw that early pop in the beginning of the year due to stimulus, kind of an artificial move. But I have a nice little thought a technical thought on a way to view that. But I'll get to that in a minute. But really, so it tops out at 55 or just under 55, and then falls all the way down to the low 30s, mid 30s. Now, that's quite a correction. I mean, you're talking 30% or more, almost 35%. And if we're looking at the weekly chart on the FXI, that already pulled back half of what it's gained from 2008. So incredibly, in a short period of time, in 6 months, we've seen China try to break out to new highs in the last 5 years or so, and then find itself all the way back to where it was at its low point in 2011. Now, if you're looking at that chart on the weekly chart, there is a steady primary trend line, a 45-degree trend line, that it retested. That, in addition to the 50% retracement at about 36 and change, all gives us a pretty ideal support zone. So for the FXI, these lows in August are critical. And I'm talking about the entire recovery of the last 6 years. We do have some oversold indicators, namely the relative strength has bottomed under the 30 level, and the pullback from August and earlier this year almost hit the 61.8% retracement. Now, that 618, a lot of harmonic traders know, is a probably one of the most important ratios, a primary ratio within the approach. But that 50% retracement level to the 61.8% retracement level, from a harmonic trading perspective, that really defines kind of the last chance if this is going to be a continuation of this multi-year, this 6-7 year recovery since 2008. It pretty much needs to hold right there. So that sets up the entire scenario where we can keep an eye on the Chinese market. But I will say this. If this goes under these lows that were established back in August, then the Chinese market will go all the way below the 2008 low, all the way down at $20. And so we're really early. A lot of people were saying that China's overdone, it's oversold. Maybe there's an opportunity there. I don't think the risk to reward yet favors that. I think you would need to see more time from a technical perspective before I could make that assessment. But no, certainly that news continues to reinforce two concepts. One, you can't trust those government numbers. The story that's being reported is not accurate. And two, it doesn't really match up. This 6.97% growth doesn't match up with what the charts are saying. If anything, the charts are saying, at best, the progress of these equities and their market has been sideways. And if anything, we're now sitting at a point where a great deal of caution has to be taken note of, because if this does get worse, and let's say China contracts further, and let's say it's not 7%, let's say by this time next year, they're saying, okay, well, it's probably only going to be 5% growth. If you see that kind of a story, that's really going to raise further concerns that actually, yeah, these guys they're fudging their numbers, a lot like we do in this country too, but everyone's looking to China for its growth. And, 30% of the world growth in the last 10 years has come from China. So if that slows down, definitely that's going to affect our markets. That will make our way to our markets. But I'd keep an eye on that FXI. And again, that recent low is at about 32.50 and on a weekly chart. And again, if that violates that 32.50, if we see China roll over again, and you watch that FXI and that thing continues to break down, 32 is the number, and it goes under 32, then what you're looking at is an entire correction of the 2008 recovery, and probably take it out below those lows. It's interesting you bring up China, because I've been looking at a lot of international markets lately, looking at the BRICS, the Brazil, Russia, India, China. They're all decimated. They were the darling growth stories of the first decade of the century, and now they're all at least 30 to 50% off their highs. Brazil, 80% off its highs. Russia, almost the same. And so all of these markets clearly have been in a bear market territory for quite some time, but actually on the verge of what some would describe as a depression. I mean, Brazil is truly the case story that's led us down in the last few years, where their market is down 75% or more. And if we go lower than these August lows, and this applies to the United States as well, but these August lows will define what will happen. I mean, they are the last technical level, harmonic trading level that we can consider before we see a much larger bear market take shape.
So, Scott, just to go back to a point that you made earlier, you were saying that 5% growth for China would be more likely what they would experience. Experts from the outside looking in are saying it's more like 4.5%, so you're right on mark there. Let's shift gears a little bit. You hit on it a little bit earlier about technical stocks, so let's talk technical stocks right now, between Apple, Tesla, all these ones out there. What are you liking out there right now in terms of technical?
Well, the tech stocks, they really are, I think, are telling a divergent story here. You got more than 50% of all NASDAQ composite stocks that are more than 20% off their all-time highs, and many of these even more so. Now, the problem you have, especially in an index like the NASDAQ, is that it's weighted. And the way that it's weighted favors the larger companies like Apple, like Google, Amazon, Facebook. You got biotechs like Gilead. And then you got even some of those old tech stocks like Intel, Google. Now, the problem is that Apple has held itself up pretty well, although it is actually about 15% off its all-time high. You have other stocks, say like Facebook. Now, Facebook is a remarkable story. Facebook almost on the verge of, or very close to its all-time high, despite all the issues with the market. And, it looks like a great momentum stock, and looks like, Facebook could go higher. And, that's been, a stock that people have continually piled into over the last couple of years, especially after that botched IPO, after that thing stabilized and turned around, it reversed. That has been just an absolute monster. I actually, back in my Twitter feed about a year and a half ago, back in 2013, it was about September 2013, and I invite everybody to check it out because I had described a failed pattern in Facebook at about $35, and that was a great signal actually to buy that continuation. And I had a target up at around 70. Well, forget about that target at 70. That thing's trading almost 100 now. And Facebook looks like it's poised to break out. The problem is though, you're in such a late stage of this tech rally where we can see an acceleration. But the problem is that very typical of a late stage bull market is that you get people piling into momentum stocks, and then when they do peak, there's real trouble. We talked about the bearish bat pattern. This is that weekly bearish pattern in the NASDAQ, both in the NASDAQ 100 but NASDAQ composite. And that has like a stamp, if you will. That for me is undeniably, from a structural basis, cannot be ignored. And that basically tells us that the NASDAQ at about 4,800 to 5,000 is a huge sell. Now, how can that be? Well, we've got stocks like Facebook and Apple doing relatively well, but you have the broader market, the broader tech stocks weakening. We've seen trouble in stocks like Twitter. We've seen a lot of the biotech stocks like Gilead and some of these other ones that were high flyers in the last couple of years start to really get affected, start to pull back 10, 20, 30% for the first time in a few years. So, we see that weakening begin to broaden out. At the same time, you see those momentum leaders like Apple, like Amazon, like Facebook, like Gilead, where, people are pretty confused. They don't know where to go, so where are they going to go? Especially those hedge funds. They're going to put their money into those last remaining stocks that are still outperforming the market. All of these signs, to me, looking at the market for 25, 30 years now, tell me that this is a late-stage bull run. We are currently sitting at a very important inflection point in the NASDAQ Composite Index. And right now we're looking at retesting those all-time highs. And I talked a bit about this last month, but right now we're faced with a very critical bearish pattern on the daily chart. And it's a simple bearish ABCD pattern. A lot of harmonic traders are aware of that pattern. This ABCD actually is forming kind of a lot of them know the most popular pattern called a Gartley pattern. And the Gartley pattern here for the NASDAQ, and especially the NASDAQ 100, which is even clearer than the composite itself, is probably the index I'd be paying most attention to. But looking at that, and this is all in reaction to what happened since August. We completed our peak back in July, early July, and you and I talked about that in one of our first shows of how a lot of these tech stocks were pretty exhausted. There was good earnings reports, yet the market went sideways. And then when more earnings reports came out, that's when the market started to really drop. But if we're looking at the NASDAQ composite here, we're looking at the NASDAQ 100. We've got this set up right now where for the short term, we're still going to go higher. But it's this next test, this next retest of the prior all-time highs is going to be the big marking of whether or not this big bearish bat pattern on the weekly chart is going to signal a double top at 5,000 in the NASDAQ. And it doesn't leave us any room for possibilities either. Because if let's say, the market caught a bid and started, for whatever reason, there's some developments, earnings, who knows. But the situation changed and things started to look better. That would have to really entail a powerful breakout for this pattern to fail. And that's, for me, one of the advantages of the harmonic trading approach is that it limits our possibilities down to one or two scenarios. In this case, the big bearish bat pattern is telling us caution. We got trouble ahead. Don't ignore these numbers. It's that simple. We need to pay attention to what's going on here. We saw the initial reaction of this in August, from the peak in July down to the low in mid to late August. For me, that was kind of the first move. That's the first natural harmonic reaction to this pattern. I call that a type 1 reversal, and that principle applies if you're on an intraday chart or looking at a weekly, which is what this big bat pattern is, a 15-year pattern. So you got to remember, this is going to take some time to resolve itself, but we are in the early stages. And now on the daily chart, as we come to retest these recent all-time highs, that's going to be the true make or break. And I put this post up, and I mentioned this in my monthly report, that if we're in a bear market, a lot of times you don't even realize it, and you don't know it until we're actually in the second leg of a bear market. Because a lot of times the first leg of the bear market is that initial reaction. We saw this in 2000, where the initial peak in the tech stocks in 2000 had a sharp correction, much like it did this year. And then it moved sideways for about 9 months before the larger devastation and destruction set in. So, we've got a top-heavy weighted average index in the tech stocks that I think is masking what the real situation is. And just to look at Facebook, I started out as a fundamental trader. I have an accounting degree, so it's just in my blood to take a look at balance sheets every once in a while. I don't pay too much attention to it, but I like to look at price to earnings, but I even like to look better at like price to sales, those kind of things. Facebook is trading right now 18 times current sales. A fair valuation for most companies is 1 times current sales. Now, we've seen these type of extremes before. We've seen crazy stocks, especially in 2000, where crazy .com stocks traded 40 times sales. But I'm not too comfortable with, I don't care how big Facebook thinks it can be or eventually will be. You're talking about a company that is definitely growing double digits year over year, but we're talking about absurd fundamental valuations. And I think that's something that anyone can appreciate, whether you look at charts, you look at harmonic trading or not. You can recognize, most people can recognize historic averages of what these earnings have traded at, PE earnings, trailing or forward, or in a case like Facebook, where you're looking at an 18 times current sales. And now, yeah, this stock could go to new highs, Facebook in particular, But I would. These are all cautionary signs that tell me that right now I would want to sit on my hands. If I was not invested in the market, I would want to be on the sidelines until I saw other constructive activity that would suggest that, maybe this tech situation isn't as bad as it looks. But right now, all the signs tell me to be cautious and to pay close attention to what the NASDAQ and the tech stocks are doing.
Extremely insightful, Scott. We appreciate your opinion on that and the harmonic trading approach to figure out what you had just talked about. And so let's talk about your final thoughts for this month as we head into the big retail season, Christmas and holidays coming up.
Well, Jonas, it really is. It's an interesting time to be involved with the markets because this is a moment where, the charts are saying one thing and the governments and the media are saying something different. And I really think, we could see a situation where the markets get stretched out and kind of drift higher into the end of the year. And maybe there's a number of different daily patterns right now. We have the same pattern in the S&P 500 and to a lesser extent the Dow. But I will say this, that we're going to resolve whether or not this is a bear market very soon, and probably within the next 4 to 6 weeks. We will know outright whether or not this is a bear market. In my opinion, I wrote in my monthly report that the Dow Jones Industrial Average has already cracked its 7-year bullish uptrend. And we've done this 2 previous times. In 2000 and 2008, both times after we clearly violated the bullish channel. It took some time. It took a few months. But what happened was that after that initial violation, the market kind of consolidated and then rolled over about 4 to 6 months later. That's what I'm looking for here. I think all of the signs point to a decline in 2016, and we will get those confirmation signals probably that by the time we talk next month or certainly by December.
All right, Scott, we appreciate your insightfulness and your predictions on what Harmonic Trader sees is happening in the market coming up. If you'd like more information, please visit Scott's website at harmonictrader.com. Until next month, have a good one.